at the broader Asian region at the moment, where the opportunities are. Of course, a lot dealing with what's going on in China at the moment, particularly with COVID. Geoff Bazzan from Maple Brown Abbott joining us now live. Geoff, good to talk to you.
G'day, Andrew.
All right, so let's begin in China. We've got the latest inflation figures out, which are a touch higher than expected. But more broadly, I guess it's that issue that's going on with COVID at the moment. There are broad lockdowns. How is that impacting, particularly, I guess, company growth there at the moment?
Yeah, sure. Look, it's inevitable it'll have an impact on short-term growth. I think most people thought the 5.5% annual GDP target was probably a stretch when they announced it early in the year. So this makes it even more difficult, I suspect. Mind you, we've only seen some modest stimulus applied to date in terms of monetary and fiscal. Of course, they're hamstrung with the economy being locked up, or parts of it, to do much on that front. But you know, as we go into the second half and hopefully some of the lockdowns ease and they get on top of Omicron, you may expect that to be a bit of a tailwind that perhaps the market's certainly not really discounting at this point in time.
So how investable is China at the moment? Certainly speaking to some fundies over the course of the past few months, they say it is uninvestable. Moreover, given what's going on with the uncertainty over the regulatory framework that's in place there at the moment, of course, we're seeing the possibility that Chinese companies will be delisted in the States. What's your view?
Yeah, so these are probably the same guys that were banging the table on Alibaba at $300 a share and don't want to own it at 100. So
right.
We don't share that view. We think you need to be disciplined when valuing Asian equities, including China, and we certainly try to be. With respect to your last point on the delisting, I think there's been some pretty positive actions taken in recent weeks that hopefully have really mitigated that risk. I think there seems to be some form of a deal being reached between the SEC and the Chinese equivalent to allow access to the audit papers for these Chinese companies, which will hopefully go a long way to addressing the concerns that OFAC have had. We'll have to wait and see there, but we don't think that's an existential risk that perhaps some people have been calling it out. And of course, most of the companies are dual listed in Hong Kong now anyway, so there is a flight for safety, an avenue for that capital if the worst were to happen in 2024, which, as I say, is not our assumption.
How concerned are you, though, with the property sector? Because that's still unresolved just as far as some of those companies involved there.
Yeah, but it's a highly cyclical, highly leveraged sector. We've sort of been wary of it for some time, given the amount of capital that's just poured into it over many years. Clearly, it does pose a systematic risk to the economy if it were to literally sort of unravel. We don't think that's likely, given the steps that have been taken to sort of restructure some of the more indebted developers. And of course, again, you need to remember that the so-called three red lines were put in place by the government to try and cool the sector down, to try and delever it. So you might argue in that respect they're achieving their outcomes. It's clearly a sector that poses some risk. To date, we're not heavily involved directly, but of course it does pose risk for not only China, let's be frank, for many other economies, including this one where we sit today.
All right, Geoff, let's look more broadly then at Asia, ex-Japan. What opportunities you're seeing at the moment, I guess, because we have sort of been in a bear market there as such for equities.
Yeah.
So you're seeing clearly then this as a buying opportunity.
We are, taking a medium-term view, so at least 2 to 3 years, I think you could expect to make some pretty attractive returns out of the Asian markets at these levels. I mean, historically, that's been the case where we're at levels, in many instances, on a individual stock basis that are sort of crisis-type levels, yet balance sheets are very strong. Earnings have not really been impacted by the curtailments to date, and indeed, if you look at the earnings pace for last year, I think our portfolio enjoyed something like 30% EPS growth on the back of 20-odd% in the prior year. So this is not an earnings correction, it's a correction in multiples, and that gives us confidence that as sentiment improves and hopefully we see some resolution on some of the issues you've touched on, the markets could run pretty hard, would be our sense.
Any particular sectors you're focused on at this point, or countries indeed.
Yeah. So to date, we've been reasonably well positioned within the market in terms of being overweight some of the cyclicals that have benefited from the rotation we've seen globally. So some of our oil or integrated energy names have done well. Some of our depressed sort of consumer discretionary stocks have performed pretty nicely. But more recently, I'd have to say, we've been nibbling away at some of those tech stocks, including, Baba at just over $100, and we like Tencent a lot more at $350 than we did when it was 700 barely a year ago. So there's no shortage of stocks to buy. Probably the only exception would be India. That market has performed very strongly and is priced quite highly on an historic context, and certainly relative to the rest of the region. But we still own a few stocks there that are continuing to operate quite strongly. So yeah, hate to sound like a perennial bullish fund manager, but on a medium-term view, we are.
It's good to be positive, particularly in this environment where it's been overly negative, I guess, but particularly given the broader macro picture at the moment, geopolitically, how it's playing out with Ukraine and how that's affecting the Asian region, I guess, as far as resources are concerned and supply chains, but also more globally, the picture with where inflation's going at the moment.
Yeah, there's a lot of big sort of picture issues to contend with. We wouldn't dispute that, but I would simply say that a lot of those negative items are baked into prices, particularly across emerging markets and particularly in Asia, especially China. The same sort of concern isn't shown elsewhere. It's quite extraordinary, frankly, given the run up in long yields that we've seen, how well some of the big DMs have held in place, notably the US. So on a relative valuation and a relative return perspective, I think investors could be rewarded quite nicely for embracing some of that uncertainty with respect to their EM or their Asian exposures.